every Monday to Friday. This is Peter Lewis's Money Talk.
Money Talk.
Good morning and welcome to Friday. This is Peter Lewis with Money Talk for the final time this week on Friday the 24th of May. This podcast is sponsored by Surfin Group, and that's headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, China has started 2 days of military exercises around Taiwan. The drills come 3 days after the inauguration of President William Lai, who has been called a dangerous troublemaker by Beijing. A spokesperson for the Chinese People's Liberation Army called the drills a harsh punishment for separatist plots for independence and a serious warning against outside interference and provocations. Leaders of South Korea, China and Japan will meet next week in Seoul for their first trilateral talks in more than 4 years. The trilateral summit among South Korean President Yoon Suk-yeol, Chinese President Li Qiang and Japanese Prime Minister Fumio Kishida will take place in Seoul on Monday. The three leaders are scheduled to hold bilateral talks among themselves on Sunday, according to the South Korean Presidential Office. The annual inflation rate in Hong Kong slowed to 1.1% in April from 2% in the previous month, and below economists' forecasts of 2.1%. It was the lowest inflation rate since June 2021. The underlying inflation rate, which excludes subsidies, ticked down 0.9% in April compared to 1% in the prior period, and on a monthly basis, consumer prices fell 0.7% after showing no growth in the previous month. Business activity in the US private sector has hit the highest level in over 2 years. The S&P Global US Composite PMI surged to 54.4 in May, up from April's 51.3, marking the highest level since April 2022 and beating market expectations. The service sector drove the upturn with a PMI of 54.8, up from 51.3 in the previous month, the biggest growth in a year. But input costs and output prices rose more quickly, with manufacturing leading the way in price growth in recent months. On today's programme, I'm joined by Francis Lun, the CEO of GEO Securities, and Sunil Kashyap, Director of Finmet. With a view from Australia is Toby Lawson, the CEO of Statton Partners down in Sydney. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com, and take a look at my Asian daily newsletter. You can also post any questions or comments there.
Peter Lewis's Money Talk.
On Wall Street Thursday, US stocks retreated from record highs hit in the morning session following NVIDIA's record earnings, after flash PMI data surged past expectations and pointed to a robust growth in the US private sector. The data also showed a fresh acceleration in inflationary pressures in May. All three major indices finished lower. The Dow saw its worst day of 2024, with the blue chip index off 606 points, or 1.5%, at 39,065. All 30 index components fell for the first time since December the 20th. The S&P 500 closed 0.7% lower at 5,268, having made small gains to reach a record intraday high earlier in the session. The losses in stocks were broad-based, with the information technology sector the only one of the S&P 500's 11 sectors logging gains, and only 54 stocks in the benchmark index advanced. The Nasdaq Composite dropped 0.4% to 16,736, also retracing an earlier advance. Shares of NVIDIA jumped 9.3%, pushing the chipmaker's market value above $2.5 trillion for the first time, following its first quarter results. Yields on interest rate sensitive 2-year treasuries rose 6 basis points to 4.94%. Yield on the 10-year note rose 5 basis points to 4.48%. The US dollar index paired early losses, rising 0.1% and moving above 105 on Thursday following the PMI data. Most Asian currencies weakened against the US dollar. The Malaysian ringgit led the declines, falling 0.5%. The Philippine peso dropped 0.4%. Japanese yen depreciated 0.1% towards 157 per dollar, hovering at its lowest levels in 3 weeks. The People's Bank of China set its daily fixing point, around which the renminbi can be traded, at 7.1098 a dollar. That's its weakest level since January. The offshore yuan weakened towards 7.26 renminbi per dollar, a 3-week low. Gold fell for a third day running, putting a recent rally into reverse. Spot gold fell throughout the session, ending 1.9% lower at $2,332 an ounce. And it's now about 4% off its 2024 closing highs. Oil prices also gave up their gains after the US PMIs. Brent crude oil settled 0.5% lower at a 3-month low of $81.36 a barrel. Bitcoin hit $70,000 and was then immediately sold, ending the day 3% lower at $67,240. Stocks in Hong Kong led losses in Asia, declining for a third day amid ongoing trade tensions and mainland China's punishment drills around Taiwan. The Hang Seng Index tumbled 327 points, or 1.7%, to a 2-week low of 18,869. The tech index dropped 2.4%. Alibaba ended the day 5.2% lower. Bloomberg reported that the tech giant is considering selling convertible bonds to raise $5 billion. The Shanghai Composite fell 1.3% to 3,116. That's its lowest level in over 3 weeks. And futures markets are pointing to a loss of about 1.4% at the open. That's going to be around 270 points. Index projected to start trading at around about 18,600. You can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Time to welcome our Friday morning guests. We have with us Francis Lun, the CEO of GEO Securities. Morning, Francis.
Hi, good morning.
And also with us is Sunil Kashyap, Director of Finmet. Welcome back, Sunil. Good to see you again.
Good morning. Nice to be back.
Two big things moving markets this week, really. First of all, the FOMC minutes, and secondly, the Nvidia results. Let's start with those minutes. In the minutes, there was a suggestion that Federal Reserve officials might be prepared to raise interest rates if inflation picked up. That was according to the minutes of the last meeting, which was held at the start of May. Mm-hmm. And a quote from those minutes, various participants mentioned the willingness to tighten policy further should risks to inflation materialise in a way such that an action become appropriate. So do you think it's likely that would happen, or is it really just the Fed here laying out various scenarios and this is not one that's likely to happen, or do you think they're seriously considering this?
I think this is just a difference of opinion. I think the Fed Chairman Powell said very clearly that the next rate change will be a reduction, not an increase. But of course, everything can change. If the inflation kick up to 4%, I think then the Fed might increase interest rate. But when you look at the PPI release yesterday, I think the chances of an imminent rate cut is not in the cards. I don't think interest rate will come down anytime soon. So I think we will be looking at the September rate cut the earliest, if there is one.
Yeah, I think it's the Fed is just trying to keep the options open and also not sort of give a very strong feeling in one direction, downwards or upwards. And I think it's a lesson that they've learned from a couple of years ago when inflation was going up and they kept saying that this is transitory, and there seems to be, they had baked in the issue of transitory. They didn't really keep an open mind. And then they tried to follow policy on the basis of the fact that they felt that this was transitory, and they ignored the data. So this time around, I think what they're saying is, look, it doesn't matter what we feel, we're going to follow the data.
But in that case, if they are following the data, what sort of data would prompt the Fed to actually raise rates? If they're truly data dependent, presumably there are some scenarios in which the Fed might be forced to raise rates.
Yeah, I mean, I think the couple of numbers three numbers actually will determine it. One is the level of inflation. If you start seeing a spike back towards the 4% kind of levels. The second is wage growth, right? If you start seeing wage growth kicking in and salaries going up, that's going to be another big thing that will scare them. And the third is going to be unemployment. If you start seeing unemployment rates going down and you're going towards a 2% sort of level, 3%, 2% level, that's going to worry people, saying that, okay, all the factors seem to show that the economy is overheating, and so we need to do something.
So some of them factors are there, aren't they? If you look at the PMI data that came out yesterday, costs were picking up, inflation was picking up again, inflation expectations are rising, wage growth, well, certainly there were signs in Europe, weren't there, of it picking up in the data that we had yesterday as well. So there are some signs, aren't there, of some of those factors could be coming together.
Yeah, that's why the Dow Jones fell 606 points yesterday, despite a rally in NVIDIA share price. But I think inflation is really very stubborn right now. It's very difficult for using monetary policy to really tame inflationary pressure.
Although since those minutes, we've had various Fed speakers, haven't we, who have come out and basically said they don't see a rate rise as being likely. However, if a rate rise isn't likely, are we getting to the point where maybe a rate cut also is not so likely this year? Are we getting to the point now where maybe we've got to start to think there won't be any rate cuts this year at all?
Yeah, I mean, I think you've heard both the CEOs of Goldman Sachs and JP Morgan voice that opinion, right? So there is a sort of a view coming about saying that, look, don't expect rate reduction. And I think the reason why they're saying that is they just want to put that warning out into the market and let the market adjust. Clearly the market is overheated, right? You've seen the way it's gone up. So I think what the intention of all these announcements is to try and change the market view, that don't take rate reductions for granted, and then see what that change in sentiment does to the market. Right, and this adjustment we've seen is probably that kind of adjustment. So everyone's looking for some adjustment in the market so that the expectations don't go ahead of themselves.
Francis, do you think we could see no rate cuts this year?
It's possible if inflation is maintained at the 3% level all year, because the Federal Reserve said very clearly they want to see the inflation down to 2%. But I think given the figures we have seen so far, it will be difficult to fall to that level. I think the number one problem is the rents are not falling anytime soon. I think that is a big problem. The cost of housing is still very high in the U.S. Due to influx of immigrants and also illegal immigrants. So you have housing costs make up a big chunk of the core consumer index.
And also, I think, the fact is the financial markets are really on a tear, right? You see the equity markets in the U.S. are going up. Bond prices have been steady. Overall, people's 401ks are going up. And as the population ages, I think some of them are saying, look, I've got some cash here. Let me try to spend it. So when you see people trying to monetize their gains in the market, that's going to keep the economy really quite warm and quite hot. So that's going to spur demand in terms of services, products, etc. And that's why whatever the monetary policy is doing is being offset by the fact that the markets are so hot and demand is so good.
So this is really what's happening in the markets, is really loosening monetary policy, which sort of goes a bit against what Jamie Dimon was saying, because he raised the dreaded S word, didn't he? Stagflation, that the economy is going to slow and maybe sort of stall while inflation is going to remain high. Do you think? I mean, to be fair, he's been warning about that for a while, but it hasn't happened. He has been wrong, hasn't he, now for over a year on his dire warnings about what's going to happen to the US economy. But is stagflation a risk?
No, I don't think so, because I think what Jamie Dimon missed is that the the fact that artificial intelligence is driving the tech sector and also driving the economy. There's a lot of spending by the big techs on these, by buying the GPUs from NVIDIA, and everybody's buying billions of dollars, and then this drives up the entire economy.
And Jensen Huang, who's the CEO of NVIDIA, he was basically describing what's happening in AI as another industrial revolution. He said it's going to basically transform the way we work. It's going to transform our efficiency. It's going to transform corporate profits. Is he right? Is it like another industrial revolution?
Well, if Jensen Huang is right, then it will be a brave new world. But if Elon Musk is right, then we will all lose our jobs. I don't know which scenario is the correct one.
Yeah, I mean, I think this talk about people losing their jobs has been around for hundreds of years, right? Whenever you've had a change in the way human beings react to machines, you've had this situation where people are saying, "Oh, we're going to all be out of a job. Machines will take over." But I think, no, I mean, seriously, the whole AI revolution, both in terms of software and hardware, is a big change. It changes the way human beings interact with computers and the activities that computers can do. And therefore, the workflows for so many jobs are going to go through a change, just like they did when we started using computers and we started using the internet. So I think the combination of the hardware changes we saw when computers came about and the software changes we saw when the internet came about, the combination of those two are going to be faced with now with AI. It's going to change the way every job, every task that we carry out, that's going to change, because now the machines are going to be able to play a much bigger role than they were in the past. And so what it'll do is it'll change the way humans interact with machines. So it'll just change the need for what kind of jobs are more in demand compared to the current situation.
And are you seeing that already in the business you're in? Are you having to make changes or make preparations for this AI revolution?
Yeah, absolutely. I mean, I'll give you an example. It's a very small example, but things like drafting CVs or drafting letters, etc., where you needed somebody to look at it, or you wanted some draft editor to edit it. Now AI is able to edit it for you so well, right? And you don't need to go there anymore. So there are these subtle changes taking place, even in the way people search for information now. We used to use Google, people use ChatGPT because you get a much clearer picture of what you're looking for. So I think in small ways, people's attitude is changing. While the hardware and software is available, what hasn't been happened yet is the applications of that into the real world are still to come. What we've seen, the initial application is just search, right? Which is the easiest one. But how can that change? You're going to start seeing that over the coming months and years.
I wonder if the AI bot who writes people's CVs will be as good as lying and exaggerating in those CVs as the original authors are.
That's true, to some extent, I guess. But even things like, Peter, the morning summary you do, right? So you sit down and do that right now. If actually you use the last 1,000 days and fed it to an AI algorithm, from now on, they could actually generate a summary for itself.
Really? They could write it for me? It would save a lot of time.
Exactly. So they still use the public information, and then they could then write it in your style. So these kind of things are just emerging. People are just beginning to understand how to use AI properly in their day-to-day jobs.
So the thing we were wondering before NVIDIA's results was, is there still going to be the demand for AI? Is there still going to be spending on AI going forward? Because obviously we've seen a lot of spending, a lot of growth already. I think the answer from NVIDIA was a resounding yes, wasn't it, when we saw their results? I mean, the revenues jumped 262% from a year ago.
That's right. I think NVIDIA is having difficulty keeping up with demand. And so you have to keep up with the competition. If if Meta is doing it, then Google has to do it, and then Microsoft has to do it. So everybody is spending billions and billions of dollars, and then, of course, NVIDIA is producing a new generation of chips every year, and so that will create demand. And then, of course, the task that AI can do will just multiply in the future. So I think we will see this growth at least into 2025.
Yeah, and I think NVIDIA's biggest risk going forward is going to be, various other companies making special purpose chips for themselves, right? So what's going to happen is Apple is already looking at an AI chip to run its phones or its computers. So what you will start seeing is some of the big companies with deep pockets are going to invest in making chips, AI chips that work for them. Right, and then you've got TSMC, etc., who will actually manufacture those chips for you. So once you design a chip for yourself, AI chip for yourself, TSMC can actually produce it. So I think that's going to be the sort of the emerging trend going forward.
Why is it that NVIDIA is got such a market lead in this particular type of chip? Because the company really has got a very deep moat around it, isn't it?
Yeah.
Which is making it very, very hard for other people to compete. You would have thought that by now, other companies would be doing these types of chips on the sort of scale that NVIDIA is. What is it that makes NVIDIA so special?
I think that's because the software, you need to run it. I think they're called CUDA. And you have to have a certain form of instruction to it's like iOS for the iPhone. If you start using it, then you are tied to it. You have difficulty changing to another kind of architecture and language. So I think if you're using it now, then you will use it for the next 5 years. That is the problem.
So it's not just a piece of hardware. There is a software that goes around it as well that you have to get, and that's where their edge comes. Because presumably they've developed this software over a long period of time for their graphic accelerators that they were very good at making.
Yeah, I think when you look at the chip industry, there were two directions people moved in. One direction was the one that NVIDIA went on, which is high performance, and GPUs, etc., as we know. But it still was a very small niche, and most of the other chip manufacturers went towards size, trying to reduce the size to make it more miniature and to increase the number of users for that hardware. And so what's happened now is that they found that the margins really are on the high performance side and not on the small size. But they hadn't invested enough to create the infrastructure towards high performance. So I think that's where the sort of big play with NVIDIA happened.
It seems even though NVIDIA Jensen Huang said they're going to come up with new chips every year, better performance, higher performance chips, it still seems though, doesn't it, and with others coming in, that there's more demand than supply. The supply can't meet the demand for these chips at the moment.
Yeah, definitely. And if the U.S. will only relax the restriction a little bit, you will have a huge order from China. I think it's true. I think Jensen Huang is correct that we have, I think this is the third industrial revolution, something like that. We will ask the computer to do jobs for us, so freeing us from doing mundane jobs like writing an essay.
Writing a morning newsletter.
That's right.
What does this mean for the markets? I mean, NVIDIA was up over 9% overnight, so it's at a record high. It's now valued at $2.5 trillion for the first time. The market was doing all right, actually, in the morning. The market itself was at record highs, the Dow and the S&P, until those PMIs came out, which showed that there was pretty good growth in the services and manufacturing sector. Also fears about inflation rising. But how much is AI going to be driving the market, do you think, going forward?
Yeah, I mean, it's a fad, right? We had this metaverse fad a few years ago. So I think it is a fad right now. I think over the long term, AI is here to stay, but is it that big a deal in terms of the market capitalization and the influence? I doubt it. I think it'll take years for it to run. Just like when computers first came out and then internet first came out, the people who we thought would benefit initially were different from the ones that actually finally benefited from it. So I think we have to let the AI thing play out. The valuations associated with AI, I think, are overdone, just like they were for the metaverse. And so that adjustment has to take place.
Are you seeing similarities with the 1990s? Remember, there was a new technology then, wasn't there, called the internet? That was brand new. Companies got very excited about it. You know, you had the people that were involved in that, like Cisco, that provided all the routers, doing a NVIDIA really, going to record highs. And there was a huge bull market, and then the bears arrived, and it wasn't such a pretty sight after that. Do you see similarities?
I think the similarities in terms of the way things are going to play out, where what we thought were the initial players who will benefit are different from the ones that will benefit. And then also the fact that the use cases of that technology will take years to play out, right? And also, which use cases can be monetized has still to be played out for AI. In the internet, now it's been 30 odd years. If you look back, you think about what the initial use cases were, and the ones which have actually benefited from it are totally different. Right? Something like Salesforce.com didn't even exist at that time. You couldn't think about something like that, right? So I think that's how AI will play out. But for sure, I mean, the current heat in the market associated with those two letters, AI, is a bit overdone, just like they were for the internet and they were for computers earlier.
I mean, Cisco for a while in the 1990s was the world's most valuable company, but now nowhere near it. Nowhere near it.
Yeah, it's not even among the Magnificent Seven or the top 10.
yeah. What about the bond markets? We've seen Treasury yields really jump over the last few days now from the lows that they hit. The 10-year got down to 4.35% on May the 15th. It's now back up at 4.94%, knocking on that door, isn't it? That 5% level, which it sort of can't seem to get across on a permanent basis. It's made a few attempts to jump above it, but then always falls back below it. But do you think we've got to get used to Treasury yields up around that 5% level now?
I don't think it will rise above 5% because the U.S. government is $34 trillion in debt. That will increase the annual interest rate burden to something like 1.5 trillion, something like that. It's an enormous chunk of money for the Treasury, for the U.S. government. So I think the Federal Reserve will try to keep interest rate below the 5% level.
Yeah, it goes back to the discussion we had at the beginning, right, in terms of what happens to short-term interest rates first and what the Fed does. So I think all these factors of also the cost of servicing the debt is also going to play into their rate policy.
And what about Asian currencies? They seem to be the victim of what's going on in the US markets, don't they? We've seen most Asian currencies yesterday weak again, but they've been weak for a while, haven't they?
Yeah.
The Malaysian ringgit was down 0.5% yesterday. The peso dropped 0.4%. Some of these currencies are at multi-year lows. The yen's around 157. The People's Bank of China set its daily fixing at the weakest level since January. Presumably, they've got to respond, haven't they, as all these other Asian currencies slide?
Definitely, I think the key is the U.S. interest rates is still rising. I think it will be difficult for Asian currencies to keep pace with the U.S. dollar. I think what will be good for Asia is a rate cut in the U.S., but that is not in the near future. So we'll have to live with imported inflation and weak currency for a while.
Yeah, I mean, I think it's a mixed blessing. So I think if you look at most of the economies in Asia, inflation is trending downwards for them, so they are happy. But the imported inflation is also coming in. So the economies are trying to adjust to the fact that they try to reduce their import dependence as much as possible. On the other hand, weaker local currencies help the exporters in that economy. So that's why I said about a mixed blessing. On the one hand, they could be worried about imported inflation, but on the other hand, it's helping the export sector. It's also helping tourism, etc. So I think all in all, the Asian economies are not too unhappy with the current trend.
Do you think that the central banks might have to respond more to support their currencies, despite the fact that inflation is much lower here in Asia? We've seen that already in Indonesia, didn't we? That although the Bank of Indonesia this week left rates unchanged, the previous meeting they had to raise them. The Reserve Bank of Australia, their minutes showed that they were thinking of raising rates. The Reserve Bank of New Zealand, even though they left rates on hold, had quite a hawkish statement. Do you think maybe they're going to have to respond?
I think they would like to have an orderly weakening of the currency, and not let the speculators go ahead of themselves, and so that's why they're making those kind of statements. I think all in all, what I see is that the Asian currency central banks are quite comfortable watching their currencies weaken over a period of time, as long as there's no sort of sudden dips.
It's not disorderly.
That's right.
Mm-hmm. Francis, let me ask you about the local markets here. Mm-hmm. We've had sort of a 4-week rally, but it's going to come to an end this week. It looks like we're going to be down this week. The Hang Seng tumbled 327 points yesterday. The tech stocks, unlike elsewhere in the world, were quite weak here in Hong Kong. What's going on?
Well, I think yesterday's market was really undone by Alibaba, because Alibaba and PDD, Pinduoduo, announced results on the same day, and then PDD announced much better results than Alibaba. And
is it taking market share, PDD, from firms like Alibaba and JD.com?
Yes, definitely. I think in the past 2 years, two upstarts, Temu of PDD and also Shein, actually took a lion's share of the new business, especially in the U.S. Alibaba hasn't had much luck in expanding into North America, but Shein and Temu have been very successful in the North American market, and just about everybody shopping on these two websites.
And it's all discount stuff, isn't it?
That's right.
Sold very, very cheaply.
So it has shown that actually Alibaba missed the market.
But it was constrained, wasn't it, by Beijing from expanding?
But they were too arrogant, I think, in some sense. I think Ma Yun thinks that he is the god of retailing. I think he should maybe copy PDD a little bit more.
Do you think Shein, when it finally works out where it's going to have its IPO, because it's struggling to find a location at the moment, isn't it? But could it be worth more than Alibaba?
Yeah, I think so. I think according to some estimates, they are already the largest fashion retailer in the U.S. With sales of something like $24 billion a year, bigger than even Inditex, I think. So I think this is the new direction for online marketing.
And why does Alibaba need to raise $5 billion? I thought Alibaba was cash rich.
But according to their press release, they need the money to buy back shares. I don't know whether that is a good excuse or not.
And so what's the outlook going forward now for the Hang Seng? We've sort of come off this 4-week rally, which has taken us from being one of the worst performers in the world to one of the best performers in the world. Is this just a temporary pause, or is this rally running out of steam?
Yeah, I think the index might fall back to the 18,000 level before a rally again. I think Tencent and JD and others will pick up the slack from Alibaba.
Yeah, I mean, I think there's clearly some undervaluation of stocks. You have to pick the right stocks because it seems that the market seems to be moving in concert downwards. So in the process, what's happening is that some really sort of hidden diamonds are out there. So you just have to look and search for them.
It's also that we've got geopolitical issues, haven't we? They seem to be weighing on the market as well. We've got the trade tensions with the US. Now we've got these military maneuvers around Taiwan, which is impacting sentiment. Also, people seem to be doubting whether these property support measures that Beijing have announced are going to be big enough to really sort of make a difference. There seems to be a lot of other concerns as well weighing on the markets.
That's right. I personally feel that I think people will realize that the power of the party and the government is quite strong, and so they will prevail at the end.
Francis, what do you think? Are these things like the military maneuvers around Taiwan and the trade tensions, are they going to become an issue?
Well, temporarily, I think it has more effect on the Taiwan market than Hong Kong. I think this will be over in 2 weeks or something like that. And unless somebody cook up a storm, I don't think the world is really that interested in the military maneuvers in Taiwan Straits.
Well, thank you both very much. Good to hear your thoughts this morning, and have a great weekend. You heard there Francis Lun, who is the CEO of GEO Securities, Sunil Kashyap, who's Director of Finmet.
Peter Lewis's Money Talk.
I'm joined now by Toby Lawson, who is the CEO of Statton Partners down in Sydney, Australia. Morning, Toby.
Good morning, Peter.
Now, the Reserve Bank of Australia released its minutes of its last May meeting, and it looks like they were talking about possibly raising rates. Was that a bit of a shock to discover that?
I think it was quite a shock. I think the Reserve Bank had been previously saying they would never rule in or out rate hikes or rate cuts. So in essence, they were pretty much on that debate. But the fact that a couple of the members were seriously debating whether to raise rates, I think is more of a surprise. They did reaffirm, though, that they felt that inflation was still on target to hit that 2.6% level by mid-26, so a fair way away. And the market hasn't priced any particular move on interest rates before the end of the year at the earliest. So it had a little bit of impact on the market, but it certainly was a surprise to hear them actually, a positive view that they were actually thinking of raising rates.
It's not realistically going to happen, is it? It's not the most likely outcome, even though they've raised the spectre of that. And we've seen elsewhere as well people talking about maybe raising rates. But it's not the most likely outcome, is it?
No, it isn't. But yeah, you mentioned others. The Reserve Bank of New Zealand, talked about it, and their rates are at 5.5%. Their short rates, their official rates at 5.5%, and Australia's at 4.25%. And New Zealand were even contemplating a higher interest rate because of the stickiness of inflation. One of the issues in Australia, Peter, is the budget that was recently announced by the government, along with tax cuts that are hitting in 1 July, are very expansionary for the economy and flooding a fair bit of liquidity into the consumer. So this is where the Reserve Bank will have to work out whether how much impact that's going to have on inflation in terms of them reaching that last mile of reducing it down into target. And that's an area which I think the market is watching closely to see if the Reserve Bank are responding in the negative towards what the federal government have done in terms of the budget.
I'm wondering about the Reserve Bank of New Zealand, because they've sort of been a bit of the canary in the coal mine when it comes to rates, haven't they? They were the first major central bank to start raising rates, even doing it when the Fed was talking about inflation being transitory. They decided that it wasn't, and started raising rates early and quite aggressively as well. And it turned out in the end they were right. So should we sort of be taking their warnings, because their statement was quite hawkish as well this week, wasn't it? Even though they left rates on hold, should we be sort of watching that carefully as maybe a warning sign?
I think it's reasonable. New Zealand's it's a small economy, that it does often be a bit of a bellwether, and if there's a concern about stagflation, it may actually reveal itself in New Zealand more than anywhere else, because economy is struggling a bit, but inflation's very sticky. So it's definitely one to look at. I think we're seeing this. Even with the Fed minutes out this week, even with the Reserve Bank of Korea or Central Bank of Korea not cutting rates when there was a bit of expectation around, seems to be a bit of a trend now that rates are, central banks are holding back on the expectation of cutting rates soon. because inflation is sticky.
Well, that's really been the big theme of the markets. Well, there's been two big themes, haven't there, really, this week in the markets. One was those FOMC minutes, and the second one, the Nvidia earnings. But on the FOMC minutes, there were warnings there as well that maybe they might raise rates. But again, I presume the Fed is more laying out scenarios here about what could happen rather than saying this is what we think is going to be the case. But do you think maybe, though, even if rates aren't going to rise, have we really got to take cuts off the table now for this year? Maybe we're just not going to see any cuts at all.
Well, it was a celebrity hit out of almost every Fed governor this week, making clear commentary. It was very consistent. I think it was Waller, Mester, Collins, Bostic and Barr, some of them non-voting members, mind you, but all of them are out there saying we need few more months of data, or we need to sit tight. This language was really clear and consistent from speakers from the Fed all during the week, on top of what Powell had said previously. So, sitting tight suggests nothing's going to happen in a hurry. The market has dropped from a sort of 70% chance of a September cut to about a 50% chance. So the market's lost a little confidence about that. It's still possible. The series on inflation has been a bit volatile. So I think we mentioned it last week. Be careful to look at single month numbers to get a guide on rate policy. But the language this week from the Fed was pretty clear that they're sitting tight and they're not in a hurry to cut rates.
So the markets have got to presumably start pricing this in. They're still they're still not at the point where they're pricing in no rate cuts, although obviously they are starting to come down now, the expectations of rate cuts in the Fed funds futures markets, but still not there yet.
Well, last night the markets had a pretty bad run, particularly the Dow, so let's say as a bellwether, driven by stronger PMI data, but you read that as stronger PMI data reads stronger economy means no rate cuts. So it's still a rate cut impact that drove equity markets last night. Bond markets have sort of stabilised a little. Volatility's not high if you measure that by the VIX. So right now it's a bit of a holding pattern, and I'm not sure investors are particularly nervous as yet, but that can change, particularly if we continue to get some strong economic data in the quarter that we've just leading into June. That'll certainly create a little bit of expectation that we might not see rate cuts to the new year, and in that scenario, equity markets might feel a little lofty.
And that PMI data, that one of the things that came out of that was inflationary pressures were rising again. Costs were going up, both input and output costs.
Yeah, and I think even Jamie Dimon, the JP Morgan CEO, who's clearly the spokesperson for this sector and often published, he said the spectre of stagflation needs to be considered. So that type of commentary, and that's the one I guess you want to be keeping an eye out. Economic growth on part starting to taper, and we've seen that in some of the labour market figures being a little softer. But more importantly, prices staying sticky, and those PMI figures, as you suggest, the underlying price pressures are still there. And that's a dangerous thing from a point of view when you've got some of the headline economic activity slowing.
But even if there's disagreement about the number of rate cuts we're going to see this year, when they're going to start, or even if there might have to be a rate rise, the one thing that everyone does seem to agree on is that when the Fed does start going on cuts, the rates are going to bottom way higher than we've seen in past cycles, maybe around 3.5%. So that's clearly is going to be something that we've got to get used to, isn't it?
Yeah, but I don't think that's necessarily a concern, because the market's probably priced that. They'll be aware that the absolute level of rates are going to be higher over the longer term. So I suspect that if you look at, it's really when you want to look at that from a longer perspective, you look at the 10-year bond rate rather than the cash rate in terms of how that impacts the investment cycle. So at this stage, I don't necessarily think the market's mispriced that particular aspect.
Now, the other big theme of the market this week has been Nvidia and its first quarter earnings reports. Huge jump in first quarter earnings. What was it? Over 260%, and also strong guidance for the next quarter as well. I mean, people before these results, what they were wondering is there still any momentum left behind the AI theme? Is spending still going to increase on AI? Those results seem to have answered that question with a resounding yes.
Yeah, I don't think you could argue. It's pretty hard to argue with any of that data on NVIDIA results, and you saw the share price surge overnight in response, even with a negative equity market more broadly. I think the CEO is very optimistic about future growth, further technological improvements in the chips in that. I don't think the story's over, not by any stretch.
Jensen Huang, the CEO, was saying this is like a new industrial revolution. It's going to transform everything, the way we work, our leisure time, our productivity, company earnings, and so on. Is it as big as that? Is it something like, the arrival of the internet in the 1990s?
I think it's a big call, but quite possibly. I mean, this week Telstra, which is the largest telecommunications company here in Australia, announced a 10% cut in its workforce of 2,800 staff, and driven by the rise of AI and technology. So clearly, a big company like Telstra having to shed 10% of its workforce over the next 6 months tells you a lot about what's coming down the pipe when it comes to AI and technology. And if there's any jobs that are likely can be replaced, any data input, any data analytics, really are going to be replaced by AI in the short term, and then all of the other use cases will develop. Now, as with most revolutions in terms of industrial revolution, new jobs are created and new opportunities arise. So it's really about adaptation rather than fear, and opportunities rise as others go. So I suspect we'll see a big shift over the coming years in how we work, what are the sectors that are going to do well. But at the end of the day, that's not necessarily a negative. It's just another adaptation as life goes on.
What does this all mean for markets in the region? We're seeing, lots of movements in the currencies in particular, aren't we? Including the Australian dollar. They all seem to be weak against the US dollar at the moment. We've even seen some central banks like Indonesia, not this time, but previous times, having to raise rates to try and support their currencies. Are we going to see more of that?
Yeah, I think Asia's always more a China story. And so I guess that's really the focus in terms of our region. Relative to the US dollar, yes, they've been weakening. That's a function of the US dollar strength, and generally that'll continue. But China's really the story. And so, Asian economies are impacted by how China performs in the coming years. We've seen, recently now with this trade war between US and China, that provides some opportunity for satellite countries like Vietnam, Indonesia, and India to take advantage. But I suspect the trend you're seeing in terms of currency depreciation in the region is driven as much by China as it is by the US dollar strength.
And circling back to Australia, how are the Australian markets performing? We've got a weak Australia dollar there as well, haven't we? But it seems like the market, is it still at an all-time high or close to an all-time high?
Yeah, close to, in line with the US. So you tend to track, our major indices will tend to track the US. The currency is a bit weaker on the basis of US dollar strength. But recently, with the likelihood that rates are going to stay firm and not likely to be cut, I suspect currency will sort of hold its ground, relatively speaking. The economy is still going well, but we're really in what you would call a GDP per capita recession.
Well, I think we've lost Toby Lawson there, but very interesting conversation with Toby. He's the CEO of Statton Partners down in Sydney, Australia.
You're listening to Peter Lewis's Money Talk.
Money Talk.
And thanks to my guests this morning, and thank you for listening today and this week. If you want to get more details on some of the stories we've discussed this morning, please go to my website, peterlewismoneytalk.substack.com, and have a read of my daily newsletter. I'll be back on Monday when I'll be joined by Alex Wong, Director at Alex KY Wong Asset Management, and Carlos Casanova, Senior Asia Economist at UBS. Providing a view from mainland China will be Hao Hong, Chief Economist at Grow Investment Group. Have a great weekend.
Money Talk